Good evening. We begin tonight with a Federal Reserve shrugging off pressure from President Trump to lower interest rates. Instead, the Open Markets Committee, the FOMC, held rates steady for the fifth meeting in a row. The target range remains 4.25% to 4.5%. It's been that since the December of the end of last year. But, a big but, cue drum roll, two members of the committee dissented. Heaven, they wanted to lower rates by 0.25 percentage point. It's the first time for many years that has taken place. Jerome Powell, the chair, said there were strong arguments on both sides, but most felt it was important to guard against tariff-induced inflation.
On the dissents, what you want from everybody and also from a dissenter is a clear explanation of what your thinking is and what are the arguments you're making. And we had that today. The majority of the committee was of the view that inflation's a bit above target, maximum employment is at target. That calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now.
Now, the chair said US GDP came in as expected. US economy grew 3%. We've got that number today in Q2. Significant improvement from the 0.5% decline in Q1. It was driven by shortfall in imports as businesses pulled back. Remember, they stockpiled ahead of various tariff deadlines. And those imports go against GDP because it's not home produced. Therefore, well, you see how it works out. So today's number is a lot more realistic. Matt Egan is in Washington. Matt, the reasoning for not moving is clear, but the dissents, we're all focusing on the dissenters. Are we making too much of it? Reasonable people can come to that same conclusion.
Well, Richard, we might be making too much of it because I got to tell you, the guy who's in charge here, Jerome Powell, he does not sound sold on a September interest rate cut, right? He didn't rule it out, but he did note that tariffs are increasing prices for consumers. He noted there's still a lot of uncertainty here. And yeah, he does face some pushback from inside this building, right, with two Fed governors dissenting for the first time since the early 1990s. But Powell, I don't know. I mean, he doesn't sound like he's definitely in the camp of an interest rate cut at the next meeting in September. And who can blame him right now? I mean, there's still a number of major economic reports that are due out between now and that September meeting. That's not to mention who knows how many tariff announcements and Truth Social posts that could completely change the picture. So he's leaving his options open, and that makes sense.
And yet the idea of a 0.25 point, I mean, it's not groundbreaking and it's not going to be earth-shattering. I realise the president wants 1%. We're really not going to get that. But the idea of just a bit, what is the fear in that marble building of where you are at the moment? What is the fear that suddenly, if you cut 0.25, it'll be off to the races?
I think the fear is what happened 3 years ago, right? I mean, Jerome Powell remembers that the Fed was late to acknowledging the fact that the COVID-related inflation was not transitory, and they got that wrong, and that is one of the reasons why we saw a 40-year high in inflation. And I mean, let's not forget, Jerome Powell, he's thinking about his legacy. He knows he has less than a year left at the helm of the Federal Reserve, and I don't think he wants to be remembered as the guy who got it wrong after COVID and then also got it wrong under immense pressure from the White House to cut interest rates. I just talked to Michael Block, a veteran investor, and he told me that he thinks that Jerome Powell, he sounds like a guy who does not want his legacy to be bullied by President Trump. And Block noted that, I mean, it's kind of hard to make the case that the economy needs an immediate massive interest rate cut right now, nor that the financial markets do, right? I mean, you still have U.S. stocks near all-time highs. You have meme stocks back. Crypto is going to the moon. And so it's not all that obvious to many economists and observers that the economy or the market really needs easier money from the Fed.
He's in danger, though, whatever the economics of all of this. Powell's in danger of losing the public debate. because we had a meeting this morning, and one of my colleagues who's looking to build a house or buy a house is saying, why aren't they moving? Why aren't rates coming down? The economy's doing well. Well, of course, that's exactly why they're not moving. It's cause and effect. But it's very hard to make that argument to middle America.
It is. And I think that Powell, he did acknowledge some of the struggles here, right? I mean, he pointed to the fact that there's downside risk to the job market. We know that JOLTS report out the other day showed that hiring is at a one-year low. And so I do think Powell made clear that he and his colleagues are thinking about what could go wrong in the economy and whether or not they might have to eventually lower interest rates.
Right.
But I do think that he wants to make sure that they don't get this wrong and they start cutting at a time when inflation accelerates because of tariffs. So they are, Richard, as you know, they're in a tough spot here.
They are indeed. Good to see you, Matt, at the Fed. Now, as we continue, the phrase that keeps coming up, the economic uncertainty, has caused turbulent balance between the hawks and the doves. It's known as the balance of risk. The committee will carefully assess incoming data and the balance of risks. So what is the balance of risks? Well, for the hawks, who voted to keep rates steady, you have a labour market that's still very strong with unemployment at 4.1%. And you've got trade policy that is threatening to raise prices. Inflation has ticked up. But on the other hand, you've got inflation that is way down from its all-time highs. You've got an economy that's growing reasonably well. And now the Fed has pressure to hold on for both sides from the president, as President Trump, of course, is trying to put his finger firmly on the scales. Which way will the scales go? Lael Brainard is the former vice chair of the Fed. She also served as the director of President Biden's National Economic Council. Now, Lael, you told us that you would have been inclined to cut rates, but you would not have dissented. Is dissenting a big deal for the Fed govs?
Dissenting is a very big deal for members of the board. It happens very rarely. Now, these members are both Trump appointees, and they have actually dissented in the last year, so it is less unusual for them. Dissenting on monetary policy, however, is unusual, and there's a lot of deference to the chair, particularly at moments like this, where the decision between cutting today in July and waiting for 2 more months of data to see whether to cut in September, it's just a very finely balanced decision.
But if it's so finely balanced, why not just do it? Take a quarter point. I mean, what is the fear that suddenly you're going to be off to the races, inflation's going to reignite? Is not the risk of this pressure cooker as great as not doing anything? Or is there a real fear amongst policymakers that they dare not be seen to be even the perception of giving in to White House pressure?
So I don't think that's what's going on. I genuinely believe that the large majority of members of the Federal Reserve do see the threat to inflation from tariffs as being quite material. And we know that the last time tariffs were raised a fair amount, which was in the first Trump administration, it took 4 to 6 months for those tariff increases to really get passed through into consumer prices. So the reason that the large majority of the members of the Open Markets Committee has wanted to give it a little more time is because these are the crucial months when you're going to start seeing the effects of tariffs on prices. And you've got 2 more months of data that they will have in hand before September. So for them, that is the reason to wait. And of course, the labor market is still looking very balanced because unemployment is still 4.1%. So they may not be as concerned about a weakening in the labor market.
If we look at Michelle Bowman and Christopher Waller, both respected economists in their own field and in their own right, if the numbers do come in stronger than expected, they will look somewhat foolish in a sense of wanting this earlier rate cut. But on the other side, and I realise that I'm doing on the one hand, on the other hand, if you get to September and, all things being equal, we are where we are now, then doesn't it become just about impossible not to reduce rates?
Well, I do think that if the economy continues to be growing only modestly as it has been, and you see that inflation doesn't go up very much over the coming 2 months, and the labor market softens a little bit, I think that would make a very strong case to cut rates in September. The economy, we got some data this morning. It's really only growing about 1.25 percentage point over the first half of the year. So that's a much lower rate of growth than we saw last year. And that would suggest that there is a rationale to cut. And so once there's more data between now and September, that rationale is going to get stronger if inflation hasn't jumped up.
What I'm finding fascinating is that we've now got tariffs at the highest level, the average tariff, since Smoot-Hawley, and there are still some nations to factor in, and we've got, obviously some stuff like the Brazilian 50% tariff, but by and large, from an average of 3 to an average of 17%. The economy seems to be able to take it at least, and I can hear you about to chide me by saying, yes, Richard, for the moment, it looks like it's taking it. And that's really what this is. Monetary lag, tariff lag, we simply just don't know.
Well, consumers are a lot more cautious than they were this time last year. So consumer spending contribution is about half what it was. So you are seeing that caution by consumers. But as you also know, we saw a huge increase in pre-positioning in companies bringing in goods in the first quarter to get out ahead of those tariffs. And now, of course, that's what we're seeing being sold on store shelves in places like Walmart and Target. So consumers are not getting the full hit yet. And retailers are going to take as long as they can before they start passing that through, because they know consumers are sour on high prices.
So back to the actual business of making the decision. Did you, when you were on the board, did you always know going into the room how you were going to vote? And even if you did know how you were going to vote, were there private moments where you agonized and thought, like, I could go this way, I could go that way? And no amount of your staff putting in front of you this argument or the other argument or this bit of data or the other bit of data, does it ever come down to what it feels like in the gut?
It is very difficult at moments, and I imagine this meeting was one of those. Back in 2015, when I was relatively new on the Federal Reserve Board, the committee had not raised rates in a long time because the recovery from the Great Recession was so slow. And they got ready to raise rates the last month of 2015. And in my gut, I felt that this was too much for the economy, that the global economy was softening. It wasn't good for American workers and business investment. And ultimately, I went ahead and supported that rate increase. But the committee didn't move again for another year because it turned out to be a quite soft economy. So yes, there are those moments where it is a very tough decision. You gotta try to figure out whether you go with the majority, support the chair, or whether you go with your gut.
I'm grateful. Thank you so much for joining us. Thank you very much, Governor. I appreciate, Vice Chair, you coming on to the programme tonight. Thank you. Now.